Okay, welcome along everybody. My name is Steve Douglas and it's my pleasure to take you through this webinar this evening. We hope that helps you out and you haven't had to travel around and you can just sit comfortably in your office or your home and have a cup of tea or a glass of Chardonnay, whichever takes your fancy. We're hosting this to talk about the recent capital gains tax changes that were announced in last year's federal budget in May of 2012. And it's not that we've taken too long to get this to you. It's a question that the government has only just released the draft legislation from that announcement of 10 months ago. That's extremely unusual, but that's just the way it seems to have gone here. As a result, we've been monitoring it very closely, but today is the only day we can actually give you any formal update of what's going on. So hopefully this will help you out to understand what's going on and give you a better inside view of what this is about. So let's get started without any further ado. I suppose one of the things we always like to know is why is the government doing this? And quite frankly, there is no real reason. When the Assistant Treasurer David Bradbury released the press announcement with the draft legislation on the 8th of March, on his website he did this very incredible quote where they truly don't believe the discount will affect in any way someone's decision for a foreign investor to invest in Australia. So the tax impact of this change seems to be negligible in their mind. Now this, of course, is probably an incredibly absurd assertion because tax is always a consequence of investment and people give it a lot of consideration, particularly with Australia where we do tend to have quite a poor reputation for tax, and one that I've spent almost 20 years trying to defend and show people that it's not that bad after all. But the government sincerely thinks that it will not impact any amount of foreign investment whatsoever. And this probably is our best way to fight this because I think that they're incorrect on this front. And if we can show them good logic as to what impact this may have on foreign investment, then we have a very, very good chance of being able to stop this change coming in. Now, we're not opposed to this new tax as such. It's not a question that we're worried about our clients having higher tax burdens. In fact, it's not necessarily going to lead to a higher tax burden for a number of reasons, including the fact that we can negative gear our properties and offset capital gains, and also probably more easily is the fact that we don't have to sell. If we never ever sell our properties, then we don't crystallise the capital gains tax liability for many, many years, many, many generations. It will just pass from one generation to the other through the wills. Inheriting property in Australia doesn't trigger capital gains tax. It passes it through. So if you ever want to make sure that you're never going to pay this additional capital gains tax potentially, then just make sure that you never sell and leave instructions to your heirs to never sell too. So as a result, there's no guarantee that the government will actually collect more revenue on this, and whatever is going to be collected is negligible. They've conceded that insofar as that they only expect $44 million worth of collections, $55 million of collections over 4 years, which is very small in comparison with the risk that they're taking. But we're opposed to it on some fundamental grounds, and the first one, I suppose, is a question of fairness. We don't believe wholeheartedly that there should be a difference between the way a foreigner and an expatriate is taxed as opposed to an Australian resident living in Australia. We need to encourage investment in Australia from a number of sources, including foreign investment, including domestic. And we need to give as much incentive as we can because we still do carry very high tax rates. So if we are going to keep those tax rates into the future, we need to be able to encourage through tax concessions such as the discount to ensure that that money goes into the most appropriate source. And fairness is a cornerstone of our system. And when the government, as you can see from our picture there of Mr. Swan, when he announced the budget, their whole philosophy was strong economy, fair Australia. Well, it's unusual to carry a fair Australia tag if indeed you're about to discriminate against a very large population. Expatriates are now going to be actually penalised for being overseas. Now that again is a very unusual thing when you consider that there's almost 1 million Australians living overseas, by the latest count. That's an enormous amount of our population, almost 5% of the Australian population living abroad. Now, for the most part, they are advancing Australia. They're advancing us from a commercial point of view with businesses. They're advancing us from a learning point of view by picking up new skills and bringing them home with them. And they're also significantly investing in Australia through property, through having children there, through having partners at times, through a variety of means, supporting families, etc. Now, we're about to have them penalised for being abroad. And that is a very, very unusual step and certainly is not one that's welcome. Strange enough, both of these issues of fairness and expatriate activity are key government policies in the recent Australian White Paper on the Asian Century. In both of those, they've been identified as key elements to ensure Australia benefits from the Asian boom. In fact, it is a stated national objective to have a fair and efficient tax system by the government. It's also a stated objective to ensure that we encourage Australians to integrate and go and be mobile within Asia and the greater world economic environment. Now, for them to now bring in a tax that penalises investment through Asia, which penalises expatriates being mobile, seems a little bit preposterous, but that's sometimes what governments do. Now, you have to wonder whether the right hand is talking to the left hand in some situations. We're also going to definitely have a disincentive for any foreigner and expatriate looking to invest into Australia. Now, Australia is a very small market on the world front, so we need every single dollar of foreign investment. And in the last 2 years, thank goodness we have had a substantial sum. In fact, the last 2 years have seen foreign investment almost double its previous average, and I'll show you that in the graph shortly. But without that, the Australian economy could have been in a bit of a mess. Now, there was some $19 billion worth of foreign investment going in, and we needed it. Now, if we all of a sudden impose an additional level of tax through taking away this discount on capital gains tax, then that will certainly affect some decision making. In fact, we've been conducting a petition online and we've collected almost 1,800 signatories, and 99% of those have said they would definitely reconsider their investment decisions if this capital gains tax comes through. Now, that is in direct contravention to what the government's contention is, that people won't mind paying more tax to invest in Australian property. Now, that $19 billion of foreign investment activity over the last 2 years has created approximately 9,500 homes additional to the normal stock in Australia each year. Now, that has been essential because Australia's property population is growing quite significantly, and so it's kept everything in check. It's also allowed the construction industry to survive a slowdown as local domestic buyer activity has reduced. In addition, had that investor activity not been there, it is highly likely that many projects in Australia, many apartment blocks, many new suburbs, many estates may not have proceeded from concept to completion. The reason being is a lot of Australians don't like buying off-plan property, where in Asia, for example, where a lot of the foreign sales go, almost 2/3 of them, it is very common to buy off-plan. And as such, developers will often come to Asia looking to sell their pre-sale requirements in order to satisfy their financiers. And that will allow them to get the project financed and start it and bring it to completion. If they are unable to achieve their pre-sale requirement, then that project is just mothballed and cannot go any further. And it will not create jobs in the construction industry, it will not create economic activity on the downline processing, and it will not create the valuable housing stock that is required for the increasing population. So it should not be underestimated how important it is to Australia for that to occur. To give you an indication of the scale, you can see that up until about 2006-2007, we were running consistently at about 4,000 units of accommodation a year, and that was ranging in value to around about $6 to $8 billion. Now, that's a substantial amount of additional investment into our property sector. Now, in the last 2 years, you can see that significantly jumped to almost 9,500 units of accommodation worth $19 billion a year. Now, that is a massive increase, and the majority of that has come from China, which has woken up in recent time and been buying almost as much property itself as the rest of the world used to buy in its entirety up until about 2008. that is somewhat scary, because that market itself doesn't like things like tax imposition. It doesn't like, to have, any sort of, negative impact coming. And so it may be a very simple thing that that market will contract quite heavily if they do not feel that they are being respected as a buyer. And certainly there's no bigger disrespect than certainly slapping on a larger tax burden, straight after you've had penetration into a market. Now, if that does reduce, people like me would be very, very happy. I'm fortunate enough to have quite a number of properties. And if the supply here does decline, from foreign buyer activity, and less projects come to fruition, then there'll be a shortage of stock. And that shortage of stock is going to be at the same time that Australia's population is rising quite sharply, and the domestic market is just starting to get some traction and coming out and buying again. Now, if we have a slowdown of supply, an increase of demand, that is inevitably going to lift in prices. So personally, I'd be nicely well off if that happens. But I have to look past my personal gain on this issue and try and look what's best for the economy overall. We cannot afford to jeopardise this foreign investment coming into Australia, because had we not had it, things within Australia would be one heck of a lot worse. We've just seen CSR announce recently that they're cutting 150 jobs out of their construction divisions because of the fact that there's not enough domestic activity. Well, imagine what it would have been like had we not had 2 years of record foreign investment coming into our property markets. Then CSR may have even probably been laying off significantly more jobs than just the 150. To give you a quick recap of capital gains in Australia, I thought it would be appropriate to just take a quick walk down memory lane. And as recently as 1985, we did not have any capital gains tax. In Australia, we had a situation where you could make any amount of profits from capital gains, the buying and selling of assets, and there was no income tax, no capital gains tax effect on it whatsoever. But you can see there amazingly that we had a tax rate at the top level of 60% of income. So by not having capital gains, we had to burden the income tax system much, much higher, and we had an incredible 60% top tax level. And that kicked in when your income was only $35,788. It's hard to believe that $35,000 back then was an enormous amount of money, and not too many people were earning it. But that was the truth. Now you can see on 20th of September 1985, the then Hawke-Keating government brought in for the first time capital gains tax. Now they weren't able to reduce the top tax rate from 60% until July 1987, when they managed to, for the first time, shift Australia's top rate under 50% and dropped it to 49%, with the threshold being at $35,000. Now what they did do though, when they recognised that they were going to bring in capital gains tax, they did one very fair thing, which was to ensure that the capital gains tax was only on the real gains made. That was that they allowed a deduction for any inflation increment on your profit. So if you didn't make profits above inflation, that meant that you in essence paid no capital gains tax. In the same way, they introduced an averaging formula that allowed lower income earners to be softened with their burden of tax by averaging over a 5-year base. So they used to take the capital gain, divide it by 5, work out the tax that would be applicable on that 1/5, and then multiply it by 5. Don't worry if you didn't understand what I was saying, because it's all gone anyways. It's all history. Now that was considered to be relatively fair, and of course people thought that would kill the property market back then, but it didn't, and it didn't because we had natural demand from growing population. Now in September 99 was the next time there was a change, so it was another 14 years before anything got altered, and that was the Howard government with Costello, and they introduced a replacement to the real capital gains issue, and they gave an encouragement for people to have real long-term investment placements by offering a 50% discount on your capital gains made, and that 50% net taxable amount was then added to your taxable income and taxed at marginal rates. Now at the time you see the top marginal rate had reduced to 47%, only just a little bit, but the threshold had increased to $50,000. Still not very much in today's terms, but back then that was considered to be a fortune. Now they did do a safety provision for people that had had assets for a long time. And so insofar as they said that if you are better off from a tax perspective to have the previous indexation allowance rather than the 50% discount, you could choose whichever created the least amount of tax. Now we did substantial modelling at the time, and we were very comfortable with the fact that you were going to be better off as an individual with a 50% discount than you would be under the real capital gains tax issues. So we were quite comfortable with that. And we thought it was a very fair system in order to encourage long-term investment in Australia, which was very much required in a growing country. Now you can see nothing has changed again until 8th of May last year, where in the federal budget, Treasurer Swan announced that they were intending to remove the 50% discount for foreign investors, which includes Australians living abroad as an expatriate. So that, of course, has been the hot topic. And for the last 10 months, we've been busily lobbying and chasing up and seeing what we can do to reduce it. Now, importantly, our top tax rate has further reduced by 2% to now be 45%. But importantly, the threshold has increased significantly to $180,000. And what that means is that under the 50% discount rules, if your only income was a capital gain, you could have effectively earned a $360,000 gain without starting to encroach upon the top marginal tax rate of 45%. With the removal of the discount for expatriates and foreign investors, now even if you make a $180,000 gain, which over a long period of time is quite achievable, then you are going to start encroaching upon that top marginal rate. So that seems to be a little bit excessive, and a little bit unfair in our mind. But that's the reality that we're potentially facing if, and I must stress if, this law does come in. Now, one of the things that's going to make it a little bit difficult for us to request that this be reviewed and, in fact, abandoned is the fact that there is a large amount of misconception in Australia. They don't quite understand what goes on when it goes in regard to foreigners. There is a genuine misbelief in Australia that it's foreigners that are forcing prices up in the property market. And let's face it, everybody when they're buying a property wants them to be as cheap as possible. But when they're selling, we always want them to be as high as possible. But there's a misconception that it is foreigners that are driving the price push. Now, one of the reasons for that is that people don't realise that foreigners must buy brand new property. Excuse me. And they have to do that in order to stimulate economic activity, create jobs, and more importantly, provide new additional housing stock into the market. Now that is essential when you have an increasing population as Australia does, and many people don't realise that Australia's population growth is probably the highest in the Western world. Now these foreigners in fact are not pushing prices up. The reality of it is that they're actually keeping prices down. By bringing new stock into the market each year, they are keeping the market in balance. When somebody needs a house, there is one additional house available for one additional migrant. And that is keeping things in check. Without that new supply and an increasing population, it's inevitable for prices to rise. There's another myth that foreigners are in there at every auction buying up all the new property, the established properties around the good suburbs. And that simply cannot occur. Under Australia's regulations, it is against the law for a foreign investor, a non-Australian citizen or permanent resident, to buy established property in our market. They cannot do it. Now, of course, many people confuse a foreigner, with a new Australian. We have record high migration. 200,000 a year are arriving in Australia for migration purposes. And when they go to an auction, they can freely buy everything. A lot of new migrants are coming from areas where they're selling assets and bringing substantial sums of money, and they are able to outpace the local Australian. But that's not a foreign investor. That is an Australian buying an Australian property. Now, there may be issues to talk about in regards to immigration, but it's certainly not an issue that should be banded around with foreign investment. Without those foreign investors buying those new properties, there would be no other alternatives for the local market. There's another misconception that expats are minted. That, if you ever get an expat call looking to buy your property, that you just, won lotto. And of course that's hardly the case. Certainly some expatriates do better than others, but most expatriates are just average mums and dads that have gone overseas to try and get a start, save a deposit, help pay out their mortgage when they get back. They're certainly not necessarily any better off in terms of position, but they may be better off in circumstance due to the offshore posting. But they're certainly not overly rich and ahead of the market. And perhaps the biggest misconception in this argument is the government's misconception that it will easily collect a small amount of $55 million over the next 4 years from this change without it impacting on any other part of the economy. Now, when I spoke to Treasury about what are the likelihoods of this law going through, the reason that they call for public comment is to see, is there any unintended consequences of bringing this law into play? And without doubt, the largest potential unintended consequence is a contraction of foreign investment activity, which was worth $19 billion, as I mentioned, last year and the year before. If that cools off, even by 10 or 15%, that would be 1,000 or 2,000 houses a year less in the Australian market at a time when our population is still continuing to expand. That would put enormous pressure on the current market, and it would not be able to cope, and hence you'd end up with all sorts of social issues and all sorts of pricing issues in the market. We cannot afford to take a chance on this at this time. Not only have we got a significant sum of foreign investment, but expatriate activity is probably worth equal to that $19 billion a year. So if we take both of those out, then we're going to have significant issues in the local market. If we want to bring these changes in, let's probably bring them in at a time where we don't have these issues, when we're suffering from oversupply of property. But that's certainly not the case with the rental market having vacancy factors of less than 2% in all major cities. A quick timeline of what's been going on with this. Well, it was 8th of May 2012 when the announcement was first made, and I use the word announcement loosely because it was hidden away in the budget papers. It was not part of the Treasurer's speech at all. On the 22nd of May, we jumped up and we put our first submission to the Treasurer, stating that we felt that it was going to have significant economic impact if they brought in this change. We didn't get to hear much from them, but I was fortunate enough that Auscham Hong Kong arranged for me to visit the Treasurer when he was presenting one of his speeches on tour in Hong Kong. So I managed to personally hand it to him, and I did warn him at the time that if he brought these changes in, it would have a serious impact on his budget, which he had just hoped to bring in at $1.5 billion surplus. And if you recall back then, it was guaranteed. It was already in the bag, that surplus. Well, we're sitting now in March of 2013, and they're already estimating that the budget deficit in this year could be past $20 billion. Now, we did predict that in our budget seminars last year, that there was no chance of achieving a surplus, and it certainly seems to bear. And that carries heavy weighting why we want to fight this particular change, because we need that additional revenue in Australia. We're now $300 billion in debt, so we need as much revenue as possible, as much foreign investment as possible, as much income stream as possible to help clear that and get the budget back in balance. Now, we followed up in January 2013 because we hadn't heard anything at all about this. And finally we were pleased to see on the 8th of March a few weeks ago that the draft legislation was finally released. Now, never in my history of over almost 30 years as a tax agent have I seen anything be announced and not released for 10 months. So I'm quite staggered at the time. I was hoping that they'd decide to say no. But I'm actually quite relieved that we've now got public comment, because finally we can start banding together. We have a clear target and we have a clear contact point in Treasury to present our case and hopefully win the argument here. Now, we've already lodged a detailed second submission. Both of those first and second submissions are available on our website. If you feel like reading the entirety of them, I'd encourage you to do so. There is a lot of facts. It's not an emotional argument. It's a sensible argument, and it's a very sincere, caring of Australia argument. So hopefully it's there. Now, we have until the 5th of April before Treasury closes off for public submissions. We will be probably lodging another submission, including the results of our petition. But if you want to contact Treasury, there'll be details on our website, details on our emails. You'll be able to get that. And we're hoping that by 14th of May, when the 2013 budget comes out, we should hopefully have good news as to what is happening with this change, proposed, cancelled, or coming into law. But they're the real timelines that we've had, and it's taken a long time to get here, but we are starting to see light at the end of the tunnel. Now, in regards to if this change comes in, and I will stress that it is still a very strong if, then the main element, of course, is the removal of the current 50% capital gains tax discount when gains are made in Australia. Now, you only have to hold the asset for more than 12 months for that to be achieved, but that's proposed to now be removed for foreign investors. Now, one of the issues is foreign investors is defined as anyone living out of Australia. So it's not just foreign nationals, it's also including expatriates that are living out of Australia. And again, there's that fairness provision, which is changing an Australian from being equally taxed all over the world to differently taxed. Ironically, one of the great things is that an Australian investing in Australia, while living overseas, will now not be entitled to his 50% discount, where an Australian living in Australia, sending Australia's valuable capital overseas to Bali, Italy, Europe, wherever, they will get the 50% discount for their investment in that foreign country. And that seems ludicrous to me. Importantly, though, if you had property as at the 8th of May, then that will still be entitled to its 50% discount. You will not have to worry about that being lost. That's going to remain at all times. You will just need to do a valuation on your property as to what it was worth on the 8th of May, if and when the law gets passed. And then the gains between original cost and that valuation will be entitled to 50% discount. The gains after the 8th of May will be proportionately adjusted for the time that you held the asset while living abroad. This change will not impact any of the current capital gains tax concessions in place. For example, for the principal residence exemption for expatriates that move overseas, they will get a 6-year tax-free period even if the property is rented. That will stay in play and will not impact on these changes. So that does not need to be worried about. But one of the things that is concerning to us is that for any expatriate, they will still be taxed on foreign income, or have their discount reduced, I should say, for their period of foreign service, even once they return back to Australia. So if you go back to Australia in 3 or 4 years and you have been overseas, owned a property, when you eventually sell it whilst living back in Australia, the discount will be proportionately reduced to reflect the time that you own that asset while living abroad after the 8th of May 2012. And that certainly seems to be a very unfair hit. To have a look at the physical cost of this, this is our famous property tax estimator, which is available on our websites, and we go through a lot in our seminars, etc. Now this is showing the effect of buying a property in Australia, holding it for 5 years, and then selling it when you've got different levels of financing on the property. Now, there's always been an encouragement to have finance on your property. It's certainly reduced your capital gains tax significantly. It's a sensible and legitimate form of financial planning, and you can see it definitely improves your return. If you had paid cash for this property, the after-tax return, assuming a 7% annual increase in value, would be approximately 6.83%. That's after paying some income tax of $15,000 and some capital gains tax of $70,000. Now the same property, the same rents, the same everything, but utilising some of the bank's money instead of your own, if you took advantage of the 80% maximum, you can see that would reduce your tax bill on income tax to 0 from the $15,000, and the capital gains tax would reduce from the $70,000 to the $46,000 by using the leveraging benefits and the deduction of the interest over the years of ownership. Now what that does, it ensures that you've used less of your money to make the same gain on the property, and you've had some tax benefits. So that's in essence increased your after-tax return from the 6.83% up to 14.03% after tax. Now this is after bringing into effect the full removal of the discount. So this is assuming that you've lived overseas the entire period of ownership and sold and not been entitled to the discount at all. Now, under the old rules, had you had the discount, you can see the after-tax return would have actually been 17.18%. So it's about 3% better off under the old rules than the new. Now, with the way that the legislation is drafted, it will now be all but impossible to know whether you'll be getting 14% or 17% after-tax return. And the reason for that is that it's prorated depending on your period overseas. If you keep your property for the longer term and still have it when you return to Australia and live in Australia for a longer period of time, you will be closer to the 17% than the 14%. However, if you sell your property whilst overseas, you'll be at the 14%. Or if you sell your property after soon returning to Australia, you'll be closer to the 14% than the 17%. So it's impossible to be accurate anymore because it's now a question of how long did you live in Australia, how long did you live overseas after the 8th of May. But that will depend greatly from person to person. But the basic rule there is simply don't sell as long as you possibly can, and hopefully for as long as you've been living back in Australia in the future. What you really need to do in regards to all of this, well, it's very important, firstly, that you make sure that you don't panic. You know, there is no need to go crazy. You can see that even if this law comes in, and I will remind you, it is still not law. It is still a maybe rather than a definite. If it comes in, your return would drop from the 17% old rules to the 14% after-tax new rules. But 14% is still a genuine, attractive investment for a high-quality, safe asset in Australia. So it's still acceptable. It's just not as encouraging. And that's why we think there'll be a reduction in activity, but there shouldn't necessarily be a mass, panic and a sell-off in Australia. What you can do, though, is make sure you join the fight. The most important thing for you to do now is to join our petition. Tell your friends, spread the word and make sure we get as many people on that petition as possible. It's only if we have as many sign-ups on that petition as we possibly can that we can get treated seriously. Now, we're already at 1,800, which is a phenomenal amount, but we need more. Every vote counts. If you can tell your friends, get yourself on it, just anyone at all, just let it happen. Now, the important thing now is before you decide on what to do, make sure we see the law come through Parliament. If it is not passed, then all of this is just, oxygen being passed around. Now, it is no guarantee it will pass through Parliament. You can see right now that it is a hung Parliament. They're having troubles passing any legislation. So something as important as this should be able to get the independents and the Greens to stand up and protect Australia over policy. And I remind you, what we're trying to raise here from the government's perspective is just $55 million over 4 years, as opposed to $19 billion a year plus expatriate activity. So there is a very, very profound financial and logical argument to be had. Now, if the law is passed, then what we do need to do is arrange a valuation of your property as at the 8th of May 2012. Now, don't go do that yourself, and certainly don't go do it yet. We will arrange a group valuation. We have valuers waiting on standby for that at discounted rates because we'll be doing it in bulk and will be at sensible valuations. So don't worry about it until we tell you otherwise. What you should seriously consider is make sure you defer all sales decisions. Not just because I don't want you to panic and just throw out the baby with the bathwater, but because I genuinely believe that if this change comes in and if foreign investment activity is reduced, as it likely will be, then we will end up with a shortage of property in Australia and we'll have a continuing high demand. So whenever you've got low supply, high demand, there is an inevitable lift in prices. So you'd be far better to sell later on when the panic sets in and people realize that they made a mistake. You seriously do not want to be considering selling in the short term. If anything, you should be trying to preempt that panic that may occur, and you should be considering filling the shortage, getting your property before it's too hard to find one. The population growth in Australia has peaked back up at 1.6%, 400,000 a year. That is an enormous amount when there's very little supply coming into the market. So if you've been thinking about buying, make sure you think a bit harder. Okay, In finishing off, just some of the things that I'd like to make sure that you go away remembering, and the most important is that this is not yet law. We don't have to start worrying about what it will do because it's not yet etched in stone. We have until the 5th of April to get together and to stand up and see if we can be loud enough to make a change. It is definitely possible and probably likely that we can get this change cancelled. So whatever you do, make sure you stand with us and do it. Just to remind you, this is absolutely fantastic news if this comes through, if you already own property. The price pressures will definitely be upward, not downward, but it is definitely bad for the country. So we want to stop this, not because it's going to be good for us by less tax, but it's going to be good for us because it'll keep the market stable. Now, Australia is not the most dynamic market. It is not the highest growth market. What it is known for and what it is good for is being reliable, consistent and secure. We don't need unusual price pressures, jumping prices and then causing instability in the market. I'd rather stay stable than be too profitable in the short term. Make sure you join the petition if you haven't already, and please encourage your family, your friends, your colleagues, everyone to join it as well. We need to get it up as high as possible. Poke your chamber in the ribs, talk to your local ambassador, email your members of parliament, do whatever it takes to get noticed. We need to do it. It is an election year after all. These guys need to know that there is a million voices overseas that should be reckoned with. And then hopefully, come 2013 federal budget, on the 14th of May, we should have some good news that we've had a good campaign, we've had our logical argument accepted in the community, and that hopefully they will have abandoned their intention to bring this through. I remain extremely hopeful, having spoke to Treasury, having looked and researched the amount very, very deeply. I still feel very strongly that we can win this, but it will be a question of numbers, it will be a question of logic, and it will be a question of protection. So hopefully if you can help us out and join the petition, together we'll make a big difference. I'm glad to tell you that that's our session for today. I really thank you for joining us. There is a questions box on your screen, so if you want to ask a few questions, by all means please do so, and I'll answer them, and then I'll let you all get on your way. So there's a couple of questions. Okay. So I've got a question. Does this affect other assets, classes like stock? No, this will not affect anything like shares and that. Shares, ironically, are capital gains tax free at the moment, and that will not change. And it will not affect anything like pre-1985 assets that are also capital gains tax free. So we've got a situation where you're going to now end up with a bigger anomaly where the property will be taxed higher and shares will be taxed free. So again, a discouragement there to invest in the necessary property and go towards more liquid assets. Let's see what I can do here. Okay. I think that's all the questions that I've got, actually, just the one. So, what we'll do is we'll call it quits for the night. I thank you very much for your attendance, and hopefully it was nice and convenient for you having the webinar, and hopefully we'll do them a few again. Next time it'll be with lots of good news at the budget seminar in May and June around the world and on webinar as well. Thank you very much for attending.